If you take a step back and look at your portfolio right about now, every single headline is telling us to panic.
Average cost for a gallon of gas in the United States, $4 a gallon.
Goldman Sachs putting the odds of a recession within the next year at 25%.
Goldman Sachs putting the odds of a recession within the next year at 25%. Goldman just updated their recession. Odds at 30%, the S&P 500 is down double digits from its highs, and the fear index just dropped to 8 out of 100. And that's extreme fear. And it hasn't been this low since 2022. And the Strait of Hormuz looks like it's going to be choking out AI and oil for months to come. And Ray Dalio, one of the greatest investors of our generation, says that we're in a stage 6 world order breakdown. And hey, I don't even know what that means, but it sounds pretty scary. But an even bigger shock is that none of this is really unique. So what if I had told you that the next steps that you take are the difference between you being wealthy versus poor? Because I went back and I studied every single recession since 1929. And what I found is that everything happening right now has happened before. Not once, not twice, but 15 times. And every single time, the same thing happens next. And the people who understood the pattern built generational wealth. It's the same kind of wealth that I started building when I invested through 2008. And that allowed me to hit my $1 million mark at the age of 38. So in this video, I'm going to show you the data. It's not going to be opinions. It's not going to be predictions, the actual historical data, and how one decision that each of us makes can determine if we come out ahead or way underwater. And I'm going to share a 5-point crash checklist that I think that every investor should have before they make their next move. Now, before I get into the data, I want to address the absolute worst case scenario first, because if you're going to trust the pattern, then you need to see what happens when it absolutely falls apart. And that example is Japan. In 1989, Japan's stock market completely crashed, and it took 35 years to recover. So if you were 40 years old and you invested at that peak, then you were 75 before you got back to even. And that is the worst case scenario, and it's completely real. But here's what really happened in Japan. Their banks kept lending money to companies that were already dead. By 2001, nearly a third of publicly traded Japanese firms were zombies that were on life support. And their corporations completely stopped borrowing and just paid down their debt. The entire economy went into a coma because the system that was supposed to clear out weak companies and let the strong ones survive and grow, it just didn't work. Now the US is fundamentally different. We restructure, we adapt. We let bad companies fail so that good ones can grow. We have the world's reserve currency, which gives the Fed a lot of tools that Japan just simply never had. And our innovation cycle, from semiconductors to AI to biotech, it just keeps generating new growth engines even when the old ones begin to stall. Japan is a lesson on how not to do it. And the lesson in the US is that the pattern of recovery has played out over a dozen times since 1929 with some very interesting changes. So let me show you. Since 1929, the US has gone through 15 recessions, and every single one followed the same pattern. The market drops, fear takes over, and then it recovers. The average decline across all 15 is down 30% from the highest point down to the lowest, and the average recession lasts about 10 months. And here's what makes this interesting. I want to walk you through a few of these because the parallels to today are very hard to ignore. In 1973, OPEC caught off oil to the US. Does that sound familiar? The S&P dropped 48%. It took about 7 years to fully recover, and in 2000, the dot-com bubble burst, and the S&P once again fell 49%. That one also took about 7 years. And in 2008, the entire financial system nearly collapsed, and once again, the S&P fell 57%. And that recovery took 5 years. And then most all of us remember COVID that hit in 2020, and the market dropped 34% in a matter of weeks, and it recovered very quickly in 5 months. And of course, there was the tariff crash last year that took the S&P down 11%, and it bounced back in 20. weeks. Now, this isn't going to be a perfect line, but the dot-com bust took just as long as the 73 crash. But if you look at the broad trend, there's 7 years, 5 years, 5 months, and 20 weeks. The tools that we have today, the speed of information, the Fed's ability to respond, and the depth of our capital markets, all of it compresses the recovery cycle in a way. That just simply didn't exist 50 years ago, and that compression looks to be accelerating. So when I look at what's happening right now, I see the same pattern that's starting all over again. And most people are going to get the timing completely wrong, because they think the signal to get back in is when things begin to feel safe. And it's not. Historically, the market peaks at about 8 months before a recession officially even starts, and it bottoms 5 to 7 months before unemployment even hits its worst point. So, by the time the headlines are at their scariest, the market has already started climbing back. Up! And here's the part that really gets me. The National Bureau of Economic Research, the group that officially declares recessions, they take 12 to 20 months to make a final call. The 2001 recession ended in November 2001. They didn't announce it was over until 2003. By then, the market was already up double digits from its bottom. So think about what that means for you. Right now, if you're sitting on the sidelines waiting for the all clear, waiting for someone to tell you that it's safe to invest again, you're going to completely miss it. Because by the time that it feels safe, the recovery's already happened. And that's the point. And that brings us to the real question. If the pattern repeats and the market moves before anyone ever expects, why do most people still lose money in a crash? It's because the crash isn't what destroys most people's wealth. It's what they do during the crash. Fidelity studied 7.1 million 401k accounts through 2008 and 2009. Same crash, same market, same economy. The people who kept contributing $500 a month through the crash saw 64% account growth by 2011. On a $100,000 portfolio, that winds up being $164,000. But the people who paused their contributions only saw a 26% growth. So they wound up with $126,000. And the people who sold out of stocks entirely, they only saw 2%. So, that only ends up with $102,000. They all had the same starting point. And the difference between staying the course and selling out early was $62,000, all from one decision. And it gets even worse. MIT found that 30.9% of investors who panic sell during a crash never come back to equities or stock, ever. That is not a temporary loss. That's permanent capital destruction. They locked in at the bottom and completely walked away, and that's 30% of the population. And that's just bonkers to me. Now, here's the part that makes this really painful. If you missed just 10 of the best trading days over a 20-year period, your returns got cut in half. So on a $500,000 portfolio, that's $250,000 just gone. And here's the kicker. Those best days landed within 2 weeks of the worst days in market history. October 13th, 2008, the single biggest gain in S&P 500 history at 11.58% in a single day. And it happened in the darkest moment of the financial crisis. And the people who had already sold, they never saw it. So the data is pretty clear. The real risk in a crash isn't the market going down, it's the decision that you make while it is down. Now, back when I worked at Amazon, we had a concept that was called one-way doors and two-way doors. A two-way door is a decision that you can reverse. You make your decision, you walk through, and if it doesn't work out, it's no big deal. You can walk right back. No harm, no foul. But a one-way door is a decision that you can never undo. So once you're through, the door closes right behind you. Selling out of the market during a crash happens to be a one-way door because the best days happen right alongside the worst days. And if you're already out, you don't get to walk back in at the same price. And the data shows that 1/3 of the people who walk through that door, they never come back. So the real question isn't whether the market recovers. It's whether you're still in it when it does. Warren Buffett has been investing through crashes for over 60 years. And he does the same thing every single time. In 1974, when the market was down nearly 50%, he said he Felt like a highly sexed man in a harem. Not gonna lie, that is a very odd choice of words. The point is, he bought the Washington Post at a quarter of what it was worth. In 2008, while everyone else was running for the exits, he deployed $14.5 billion into Goldman Sachs, GE, and Bank of America. And right now, he's sitting on $373 billion in cash after 12 consecutive quarters of net selling. And right now, the S&P is down double digits from its highs, and Berkshire happens to be up 12%. Look, he's not guessing. He's following the same pattern that we just walked through. He knows the market recovers, and he knows that it moves before the news ever catches up. And he knows that most people will make an emotional decision that costs them a heck of a lot more than the crash itself. So instead, he waits, and then he buys when everyone else is selling. And I think everyone gets that by now, but emotionally that's hard to recognize in the moment. And then, of course, there's this guy named Bob. Bob is the worst market timer in history. He only invested at the absolute peak, right before every major crash. 1972, 1987, 1999, 2007, the worst possible timing every single time. But you know what Bob never did? He never sold. He put in $184,000 over his entire lifetime. And by 2013, it was worth $1.16 million. So even the worst timing in history still beats panic selling. So here's how I think about it. Every crash creates two groups of people. One group makes a one-way door decision based on fear, and they either lock in their losses or they never even come back. And that second group happens to stay the course, and they keep investing, and they come out of it on the other side with generational wealth. And that's it. That is the one decision, and it's the same decision every single time. And if you're looking to make that decision, you need a system. Because conviction without a plan is just hope. So here's what I'd recommend. 1. Check your timeline. Are you 5 or more years from needing this money? If yes, the historical data says that you have time on your side. 2. Check your allocation. Does your portfolio match your actual risk tolerance? Not the risk tolerance that you had when the market was going up. 3. Before you even touch your portfolio, you need to ask yourself one simple question. Am I reacting to a headline, or am I reacting to what everybody else is doing? Or am I acting on a strategy? 4. If you're going to act, add, don't subtract. The Fidelity data showed that people who kept investing through the crash, they came out 62 points ahead. 5. Write down your reason for selling. Read it back in 6 months. If it still makes sense, I'm fine. But the data says it almost never does. That's your system. Print it, screenshot it, save it, do whatever you want. Because the next time the market drops and every headline is telling you to panic sell, this is the checklist that keeps you on the right side of that one-way door. And that's really what this comes down to. 15 recessions, same pattern every time. The market drops, fear takes over, and the people who stay the course come out the other side wealthier than they went into it. And the people who don't, a third of them never come back to the market. It's one decision. That's it. As a reminder, I'm not a financial advisor and I do this for educational purposes. But hey, I've been through this before. I invested through 2008 and it completely changed my life. And I genuinely want that for all of you. So I hope that the data in this video helps you think clearly when everything around you is telling you not to. If this helped you in any way see what's happening right now a little bit differently, then please consider pressing the like button so my channel can continue to grow. And as always, thanks so much for watching, and I'll see you next time.